There is a fascination among new traders that is almost impossible to cure without experience. It is the obsession with buying the absolute bottom and selling the absolute top. When a novice sees a stock falling sharply, their instinct is not to stay away but to step in and catch it. They want to be the hero who buys at the lowest penny. Conversely, when they see a stock rising powerfully, breaking new records every day, they feel an irresistible urge to bet against it. They convince themselves that it has gone too high, that it cannot possibly go further, and that gravity must take over. They try to short the high. This behavior is the primary reason why the vast majority of retail accounts are depleted within the first year. These traders are attempting to stand in front of a freight train and argue with physics. They are fighting the single most powerful force in the financial markets, momentum. Richard Wyckoff, the pioneer of modern technical analysis, had a name for the correct approach. He called it following the path of least resistance. Imagine a massive river flowing downhill. If you attempt to swim upstream, you will exhaust your energy and eventually be swept away. It does not matter how strong you are. The force of the water is greater. But if you simply turn around and float with the current, you can travel great distances with almost zero effort. The market works the same way. The trend is the current. It is created by the massive capital of institutional investors, the smart money. When they are accumulating shares, they create a tidal wave of demand that pushes prices higher. To trade against this wave is futile. To trade with it is to let the largest banks in the world carry your portfolio to new heights. The goal of this video is to rewire your brain. We are going to stop trying to predict when the trend will end and start mastering the art of staying in it while it is alive. We will treat the trend as a physical phenomenon, governed by the laws of inertia. An object in motion tends to stay in motion until acted upon by an equal and opposite force. Until you see that opposing force clearly on the chart, your only job is to ride the wave. To do this safely and profitably, you must follow 4 immutable rules. This brings us to rule number 1. Define the structure. Before you can trade a trend, you must be able to define it objectively. A trend is not a feeling. It is not a rumor on the news. It is a specific mechanical structure visible on the price chart. Many beginners look at a chart and see chaos. The professional looks at the same chart and sees a staircase. Technically, an uptrend is defined by a very simple sequence, a series of higher highs and higher lows. As long as the price continues to make a high that is above the previous high, and a low that is above the previous low, the trend remains intact. This sounds simple, but in the heat of the moment, emotions blind you. You might see a sharp red candle and think the market is crashing. But if that red candle stops at a price higher than the last pullback, the structure is not broken. It is simply the market taking a breath. To visualize this correctly, you must understand Wyckoff's law of supply and demand. In a healthy uptrend, demand is consistently greater than supply. How does this look on a chart? It looks like an asymmetry in time and distance. Look at the impulse, the move in the direction of the trend. In an uptrend, the upward moves should be long, aggressive, and cover a large distance in a short amount of time. These are the green candles that seemingly jump off the screen. This represents the smart money buying aggressively. Now look at the reaction, the pullback against the trend. These moves should be short, shallow, and lazy. They should take a long time to give back only a small percentage of the gain. This tells you that while the buyers are taking a break, the sellers are weak. There is no heavy supply hitting the market. If you see long, powerful impulses followed by weak, drifting reactions, you are looking at a healthy structure. You are looking at a market where the path of least resistance is undeniably up. To trade this structure, you cannot rely on your eyes alone. You need a tool to contain the price action. This tool is the trend channel. Most beginners draw trend lines incorrectly. They draw lines that cut through the middle of the price action, or they draw lines that fit their bias. The Wyckoff method provides a precise way to construct a channel that acts as a roadmap for the stock's journey. To build an uptrend channel, you start by identifying two significant lows, 2 points where the market fell, found support, and rallied. You draw a straight line connecting these two bottoms and extend it to the right. This is your demand line. It represents the floor of the trend. This is the zone where value investors and institutions step in to buy the dip. As long as the price stays above this line, the demand is in control. Next, you identify the highest peak that occurred between those two lows. You draw a line parallel to your demand line starting from that peak. This creates the upper boundary known as the supply line or the overbought line. You have now created a diagonal tunnel. The price should oscillate within this tunnel like a ball bouncing between two walls. This channel gives you immediate context. When the price is near the bottom demand line, the stock is oversold relative to the trend, and it is a potential buying opportunity. When the price is near the top supply line, the stock is overbought, and you should expect a reaction or a pause. This structure protects you from making emotional errors. If the price is screaming higher and hitting the top of the channel, the novice wants to buy because of the fear of missing out. The professional looks at the channel and says, "No, we are at the supply line. The risk is too high." Conversely, when the price drops and hits the demand line, the novice is scared and wants to sell. The professional sees that the structural floor holds and prepares to enter. By defining the structure with higher highs, higher lows, and a properly drawn trend channel, you stop guessing. You are no longer navigating the ocean in the dark. You have a compass. You know exactly where the current is flowing and where the boundaries of safety lie. Once this structure is defined, your next task is to verify if the engine of the trend is healthy. This leads us to the critical role of volume. Now that you have drawn your channel and defined the structure of the trend, you might be tempted to enter the market immediately. Do not do this. A beautiful car with a polished exterior is worthless if the gas tank is empty. It might roll forward for a few meters due to momentum, but without fuel, it will eventually stop and roll backward. In the stock market, the price action is the car, and the volume is the fuel. This brings us to rule number 2. Identify the fuel. To trade a trend successfully, you must look below the price chart. You must analyze the vertical bars at the bottom of the screen. These bars represent the number of shares changing hands. They tell you the truth that the price candles often hide. Richard Wyckoff codified this relationship into what he called the law of effort versus result. Think of volume as effort and price movement as the result. In a healthy, sustainable trend, the effort must match the result. If you see a massive spike in volume, meaning a huge amount of money is entering the market, you should expect to see a significant movement in price. If the smart money is pushing the accelerator to the floor, the car should speed up. When you are analyzing an uptrend, you are looking for a specific rhythmic signature in the volume. You want to see harmonic expansion. This means that on the days when the price is moving up, the green impulse candles, the volume bars should be tall and rising. This confirms that the price is rising because of aggressive demand. Institutions are stepping over each other to buy shares, and they are willing to pay higher prices to get them. This is the engine firing on all cylinders. However, the most critical signal often comes when the market moves down. Remember, in an uptrend, we expect corrections or pullbacks. When the price starts to drop against the trend, you must watch the volume like a hawk. In a healthy trend, as the price drops, the volume should wither away. The red volume bars should be significantly shorter than the green ones. Why is this important? Because low volume on a pullback tells you that there is no significant supply. It tells you that the major institutions are not selling. They are holding their positions. The price is drifting down simply because the aggressive buying has paused for a moment, not because sellers have taken control. This state is often called drying up. When you see a stock pull back to your demand line and the volume drops to almost nothing, it is one of the most bullish signals in existence. It screams that the selling pressure is non-existent and the trend is ready to resume. So, the formula for a healthy trend is simple. High volume on the way up, low volume on the way down. But you must also be vigilant for the warning signs. The trend is your friend until it ends, and volume is usually the first thing to whisper that the end is near. You must watch for divergence. Divergence occurs when the price action and the volume tell two different stories. Imagine the stock makes a new high. It breaks above the previous peak and looks strong. But when you look at the volume, the bar is lower than it was on the previous rally. The price is going up, but the participation is going down. This is a critical danger signal. It is like a car coasting uphill. It is still moving forward, but the foot is off the gas. The momentum is carrying it, but without fresh fuel, without new institutional money entering the market, gravity will soon take over. When you see the price drift higher on shrinking volume, do not be fooled by the green color of the candles. It indicates that the smart money has stopped buying. They are stepping aside. The price is being pushed up by retail traders who are late to the party. This is often the precursor to a violent reversal. Another dangerous anomaly is the violation of the effort versus result law in the opposite direction. Be very careful if you see a massive spike in volume, huge effort, but the price barely moves. Imagine a day where the volume is the highest it has been all month, but the price candle is small or it closes near the middle of its range. If there is so much buying, why didn't the price explode upward? The answer is that there was also a massive amount of hidden selling. The smart money was selling into the buying frenzy, absorbing the demand. This is called churning. It is the sound of the engine revving while the brakes are locked. When you see huge volume with no price progress at the top of a trend, it is not a sign of strength. It is a sign that the distribution has begun. By strictly following rule number 2, you filter out the weak trades. You never buy a breakout that lacks volume. You never hold a position that is rising on an empty tank. You demand that the market proves its health by showing you the money. Once you have confirmed the structure and verified the fuel, you are finally ready to execute. But you cannot just jump in anywhere. You need precision. This leads us to rule number 3, time the entry. You have defined the structure of the trend. You have verified that there is fuel in the tank through volume analysis. Now you face the most difficult psychological hurdle of all, timing the entry. This is where rule number 3 comes into play. The single greatest mistake made by the amateur trader is buying based on emotion. In the trading world, this emotion has a name, the fear of missing out. You see a stock that has just announced great news. The price is moving vertically. The green candles are long and aggressive. You feel a sense of urgency. You believe that if you do not buy now, the train will leave the station without you. So, you buy at the very top of the impulse. Almost immediately after you enter, the price stops. It reverses. It begins to drift down. You are instantly in a losing position. You watch in frustration as the stock slowly bleeds value for days or weeks, shaking you out of your position right before it turns around and rallies again. This is not bad luck. This is bad timing. The professional operates with a completely different mindset. The professional never chases the bus. If the bus has left the stop, he waits for the next one. In trading terms, this means we strictly adhere to the rule of buying the reaction, never the impulse. In an established uptrend, the impulse is the time to sit on your hands or to take profits. It is not the time to enter. The entry window only opens when the price pulls back. We are looking for a discount. We want to buy the stock when it is on sale, not when it is at a premium. But we do not just buy any pullback. We are looking for 2 specific geometric patterns that Richard Wyckoff identified as high probability entry zones. The first pattern is known as the halfway back principle. Markets rarely move in a straight line. They breathe. When a stock makes a significant move upward, let's say it rallies from $10 to $20, it creates a zone of imbalance. The buyers are exhausted. and the early profit takers want to sell. The price will naturally correct. Very often, this correction will retrace approximately 50% of the previous move. Why 50%? Because it represents a psychological equilibrium. It is the point where the buyers who missed the initial move feel that the price is fair again, and the sellers who wanted to exit have finished selling. If the stock rallies 10 points, look for a 5-point pullback. Mark that level on your chart. That is your kill zone. You do not simply place a blind order there, but you watch that level intensely. If the price stabilizes at the halfway point, it confirms that the trend is strong and healthy. The second pattern is the retest of the breakout. Wyckoff often described a resistance level as a creek. Imagine a flowing creek that the price must jump across to start a new leg of the trend. When the price finally jumps across this creek, breaking the resistance, the amateur buys immediately. The professional waits. Almost invariably, after breaking a major resistance level, the price will curve back down to touch the level it just broke. It returns to the edge of the creek to see if the ground is solid. This is a critical test. The ceiling must become the floor. Old resistance must become new support. We wait for the price to touch this old resistance line. If it bounces, we have our entry. This is the safest entry in trend trading because you have a clearly defined line in the sand. You know exactly where you are wrong. If the price falls back below the line, the breakout failed and you exit. But if it holds, you have entered at the beginning of the next major wave. However, identifying the pattern is only half the battle. You need a trigger. You need to know that the pullback is not the start of a crash. This brings us back to the most important filter in your toolkit, the low volume reaction. As the price approaches your halfway back level or your breakout retest level, you must look at the volume bars. This is your green light. You want to see the volume disappear. Imagine a ball rolling up a hill. As it runs out of momentum, it slows down, pauses, and then rolls back. In the market, we want to see the sellers running out of momentum. We want to see the volume bars getting smaller and smaller as the price drops. If the price is dropping towards your entry point, but the volume is expanding and getting higher, stand aside. That is not a correction. That is a liquidation. That is an exit sign, not an entry sign. But if the price is drifting down and the volume drops to almost zero, it tells you that the supply has evaporated. The sellers are gone. The market is effectively empty. In this vacuum, it takes only a tiny amount of buying pressure to reverse the price and send it rocketing upwards. So, the perfect entry looks like this. The price pulls back to a structural support level, like the 50% mark or the old resistance. And as it hits that level, the volume dries up completely. This is the moment you strike. You are buying when the risk is lowest and the potential reward is highest. You are buying exactly when the smart money is stepping back in to defend their campaign. By following rule number 3, you eliminate the stress of chasing the market. You stop worrying about missing out because you know that the market will always offer a reaction. You let the price come to you on your terms at your price. Once you are in the trade, you are riding the wave. But no wave lasts forever. You must know when to get off before it crashes on the shore. This leads us to our final rule. You have defined the structure, verified the volume, and timed your entry perfectly. You are now positioned in a profitable trend. But the most dangerous part of the journey has just begun. The entry is only 20% of the equation. The exit is the remaining 80%. A profit is not real until it is realized. Many traders successfully ride a wave for weeks, only to watch their gains evaporate in days because they fell in love with the position. To keep the money you have made, you must follow rule number 4. Know when to jump off. The trend is a living thing. Like any living organism, it has a lifespan. It is born, it matures, and eventually it ends. Your goal is not to predict the exact date of its end, but to recognize the symptoms of its decline. Richard Wyckoff taught us to look for a specific event known as the change of character. For the duration of a healthy uptrend, the market behaves with a consistent personality. It moves up aggressively and pulls back gently. It respects the boundaries of the trend channel we drew in the beginning. The buyers are confident and the sellers are passive. But eventually, a day comes when this personality shifts. Imagine a runner participating in a marathon. For miles, he maintains a steady, rhythmic stride. He looks strong. Suddenly, he stumbles. He clutches his chest. His pace slows down, and he begins to sway. Even if he keeps running for another mile, you know that the race is effectively over for him. His character has changed from strength to weakness. In the market, this stumble appears as a sign of weakness. You are looking for a specific visual signal, the largest downward impulse since the trend began. Look back at your chart. Throughout the rally, the red pullback candles were likely small and contained. But suddenly you see a massive red bar. It is long, it closes near its bottom, and it is accompanied by heavy volume. This red move is deeper and more violent than any correction that came before it. It drops the price significantly, perhaps breaking below the previous higher low. This is the moment the stride is broken. The heavy selling tells you that the smart money has shifted from accumulation to distribution. They are no longer supporting the price. They are unloading their inventory. When you see the largest down move in the history of the trend, do not treat it as a buying opportunity. Treat it as a fire alarm. This violent move will often break the demand line, the bottom wall of your trend channel. When the price shatters this floor, the structure is compromised. The laws of physics have changed. Gravity is now stronger than the lift. However, even when this happens, the amateur often refuses to sell. He is blinded by greed. He remembers the high prices of last week and refuses to sell for less. He holds on, hoping the price will return to the peak so he can exit at the top. This is a fatal psychological trap. You must accept a hard truth. You will never sell at the absolute top. The absolute top is a singular price point that exists for only a fleeting second. Trying to catch it is an exercise in vanity, not finance. The professional is content to capture the meat of the move, the middle 60 to 80% of the trend, and leave the head and the tail for others. Wyckoff advised that when the stride is broken and the character changes, you should look for the next rally to exit. Usually after the big drop, the market will try to bounce. But this bounce will be weak. It will rise on low volume and fail to make a new high. This is a lower high. This is the market waving goodbye. Do not hesitate. Do not hope. Sell into this weak rally. Take your profits and step aside. It is far better to sell too soon and watch the stock rise another 10% without you than to sell too late and watch it give back 50% of your hard-earned gains. By adhering to these 4 rules, you strip the emotion out of trading. Rule 1, define the structure. Rule 2, identify the fuel. Rule 3, time the entry. Rule 4, know when to jump off. You stop gambling and start operating. You stop fighting the ocean and start riding the wave. For those who are serious about mastering this craft, 2 specific resources are highly recommended. First, to understand the deeper mechanics of trend channels and volume analysis, refer to Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. The annotated edition by Max Davidson is particularly valuable as it bridges the gap between classic theory and modern markets, teaching you to judge the market solely by its own action. Second, to master the discipline required to ride a trend without selling too early out of fear, read Reminiscences of a Stock Operator by Edwin Lefebvre. This book provides the psychological armor necessary to sit tight and let the trend work for you. The links to these essential editions are provided in the description below.